There was a moment when numbers on screens became more powerful than the coins in your pocket, and almost nobody noticed it happening. Sarah checked her phone at 6:47 a.m. and saw her bank balance had changed by $1,247 overnight, not from her paycheck, but from something called interest yield optimization. She hadn't touched any physical money in 11 days, yet her wealth had supposedly grown while she slept. The app congratulated her with confetti animations, but she couldn't remember the last time she'd actually held cash that could buy groceries. Her grandmother had kept money in envelopes labeled rent and food, but Sarah's money existed only as pixels that changed color when she swiped between apps. She tried to explain this to her neighbor, who still paid for everything with crumpled 20s, and realized she couldn't actually describe where her money was. This confusion wasn't unique to Sarah. It was the feeling of living through what economists call the dematerialization of currency. What's happening here is a fundamental shift in how value gets represented, stored, and transferred in an economy. If you found this video useful, please consider subscribing, liking, sharing, and leaving a comment. It helps the channel grow and allows us to continue producing documentary-style content like this. To understand how money stopped feeling real, we need to look at what happened to the banking system between 1970 and 2020. In 1970, approximately 93% of transactions in America involved physical currency changing hands. By 2020, that number had inverted. Less than 8% of transactions involved cash, with the rest existing as electronic entries in databases. This is an example of what financial historians call the abstraction cascade. Money became information about money. Banks stopped needing vaults full of gold or paper. They needed servers that could process billions of numerical adjustments per second. The Federal Reserve itself holds most of its money as accounting entries, numbers in a system that other banks trust will balance at the end of each day. When you deposit money, the bank doesn't put your specific dollars in a drawer with your name on it. It adds a number to your account and immediately lends most of that amount to someone else. Economists describe this as fractional reserve banking, and it means that most money exists simultaneously in multiple places as promises rather than as physical objects. This pattern appears when societies shift from commodity-based money to fiat currency. Value becomes whatever the system collectively agrees to recognize. Credit cards accelerated this transformation in the 1980s by making spending feel psychologically different from handing over cash. Studies from behavioral economics show that people spend 12 to 18% more when using cards instead of cash, because the psychological pain of paying diminishes. What's happening here is that the physical feedback loop, seeing your wallet get lighter, disappears when money becomes data. By 2015, mobile payment systems like Venmo and Apple Pay added another layer of abstraction. Money became emojis and casual messages between friends. The infrastructure had fundamentally changed, but most people only noticed that paying for things had become more convenient. The moment money stopped feeling real had consequences that rippled through everyday behavior in unexpected ways. Personal debt in America increased from $5.7 trillion in 2000 to over $14.9 trillion by 2021, partly because digital spending made borrowing feel less tangible. This is an example of what psychologists call reduced transaction transparency. When the mechanism of payment becomes invisible, spending decisions bypass normal caution. Young adults who grew up never handling cash developed different neural patterns around spending. Brain scans show less activation in pain processing regions during digital purchases. Meanwhile, the stock market began exhibiting strange volatility patterns that traders called the algorithm effect. By 2015, over 70% of trading volume came from automated programs making decisions in microseconds. money moving based on mathematical patterns rather than human judgment about company value. This moment reveals how the system works. When money becomes abstract, its movement becomes detached from the physical economy of goods and services. Cryptocurrencies took this abstraction to its logical extreme. Money that existed only as encrypted entries on distributed ledgers with no government or physical asset backing it. Bitcoin's price could swing 20% in a day, not because any physical thing changed, but because collective perception shifted among people trading numbers they'd never hold. Economists describe this as reflexivity, where the price of an asset is determined not by underlying value, but by what people believe others will pay. The pandemic of 2020 accelerated these trends dramatically when physical cash became seen as a potential disease vector. Contactless payment adoption jumped from 30% to 87% in just 18 months. An infrastructure shift that normally takes decades happened in less than 2 years. Small businesses that had operated on cash for generations suddenly needed merchant accounts, tablets, and internet connectivity just to sell groceries. This pattern appears when technological adoption becomes mandatory rather than optional. Those without access to digital infrastructure get excluded from basic commerce. Central banks began seriously exploring their own digital currencies, recognizing that private companies had essentially redesigned monetary systems without public oversight. The Federal Reserve's discussion papers from 2022 acknowledged that the central bank had lost some control over monetary policy because money itself had changed form. The question isn't whether digital money is good or bad, it's what we lost and gained when value became weightless. Efficiency increased dramatically. International transfers that took weeks now complete in seconds, and transaction costs dropped from dollars to fractions of cents. But psychological connection decreased just as dramatically. Money became something you managed rather than something you experienced handling. This is an example of what sociologists call the rationalization of exchange. Human transactions become systematized, predictable, and divorced from social relationship. The marble floors and imposing columns of old banks were designed to make money feel serious and consequential. Modern fintech apps use playful fonts and gamification specifically to make spending feel casual and frictionless. What's happening here is architectural psychology. The physical and digital spaces we move through shape our relationship to value itself. Older generations often describe feeling disconnected from how their grandchildren handle money. And this isn't just generational preference, it's structural transformation. The infrastructure that made money feel real was tactile scarcity. Limited bills in your wallet created natural budgeting through physical constraint. Digital accounts removed that constraint, replacing it with credit limits determined by algorithms analyzing data most people don't know is being collected. Economists describe this as the liquidity paradox. Money became more available and movable, yet individual financial stability decreased. The average American's emergency savings dropped from covering 4 months of expenses in 1990 to less than 3 weeks by 2020, partly because liquid digital money gets spent rather than preserved. This moment reveals how the system works. Abstraction creates both freedom and vulnerability simultaneously. The businesses that profited most from money's dematerialization were those that inserted themselves between transactions. Payment processors, platforms, and intermediaries collecting fractional fees billions of times daily. What started as convenience became infrastructure, and what started as optional became mandatory for participating in modern economic life. The day money stopped feeling real wasn't a specific date. It was a gradual transformation that each person experienced at different moments when they realized the numbers had replaced the thing. Understanding this shift doesn't change whether you use cash or cards, but it reveals the invisible architecture that now mediates almost every exchange of value in modern society.